One line on a deed, one signature at a county office, and your child could be facing a $200,000 capital gains bill they never saw coming. Before you add your son or daughter to your home deed, understand what that one signature can change. You may think you are protecting your family. You may think you're avoiding probate. You may think you're making life easier for the child who helps you with bills, appointments, and paperwork. But if that deed is handled the wrong way, you may not be giving your child peace of mind. You may be handing them a capital gains problem that does not show up until the house is sold. That is what makes this mistake so dangerous. It does not always hurt on the day you sign. Nobody from the IRS shows up at your door. Nobody at the county office stops the process and says, "Are you sure you understand the tax basis?" The deed gets recorded. The family feels relieved, and everyone moves on. But years later, when the home is sold, the tax question comes back. And by then, the paper trail is already written. Robert is 72. His wife passed away a few years ago. He still lives in the home they bought decades ago, back when the price was nothing like it is today. The mortgage is paid off. The neighborhood has gone up in value. And the house is now worth far more than Robert ever imagined. Robert is not trying to beat the IRS. He's just a father who wants his daughter Lisa to avoid stress when he is gone. Lisa checks on him. She takes him to appointments, and she helps him understand confusing mail. So when someone tells Robert, "Just put Lisa's name on the deed," it sounds responsible. They tell him that way there is no probate, no court, no problem. So Robert signs the deed change. Lisa's name gets added. The family thinks the house is protected. But here is where the problem starts. A deed is not just a family note. It is an ownership document. When a child's name is added as a co-owner, ownership changes. And when ownership changes during life, the IRS can treat that transfer very differently than an inheritance. The key word is basis. Basis is the number used to measure gain when property is sold. It is not always the current value of the house. It is not what your home appraised for last year. It is the tax number behind the property. If your child receives part of the house as a lifetime gift, your child may be connected to your old basis, not a fresh value at today's market price. Let's say Robert's house went from $90,000 to $650,000 over the years. That is a real type of scenario for families who bought decades ago. That increase is not just a nice family success story. It can become taxable gain when the property is sold. Before anyone tells you, "Just add your child to the deed," stop. Ask the question they skipped. What tax problem does this create later? Now let's make the basis issue simple. Robert bought the house for $90,000. Over the years, he and his wife made improvements. Maybe they replaced the roof, updated the kitchen, changed the windows, and kept some records. Let's say his adjusted basis is around $140,000. Today, the house is worth $650,000. That sounds like good news. And in one way, it is. Robert built wealth by holding the home. But from a tax point of view, there is more than $500,000 of appreciation sitting inside that property. That appreciation is the number that can become the center of the tax problem when the house is sold. Here's where families make the wrong assumption. They think if the parent adds the child to the deed, the child's share starts fresh at today's value. They think, the house is worth $650,000 now, so that must be the number. But when property is given during life, the basis rules usually do not work that way. In most gift situations, the person receiving the gift carries over the donor's old basis for gain purposes. Robert thinks Lisa is receiving protection, but Lisa is also receiving part of Robert's old tax history. If the home is sold later, Lisa is not automatically taxed as if she bought her share at today's market value. She can be connected to the old basis that started decades ago, the same old basis from when Robert bought the house for a much lower price. This is why just add your child to the deed is dangerous advice. It solves the visible fear, but it ignores the hidden tax cost. Avoiding probate and avoiding capital gains are not the same thing. A move that avoids one problem can accidentally create another. Imagine Lisa is added as a 50% owner. She does not pay Robert for that share. She does not move into the house. She keeps living in her own home. A few years pass, and the family decides to sell Robert's house. Now the tax professional starts asking questions. When was Lisa added? Was it a gift? What was the property worth at that time? What was Robert's adjusted basis? Did Lisa live in the home? Did Lisa qualify for the home sale exclusion? What share did she own? That is the moment the family realizes this was never just paperwork. Same house, different route, different tax result. That is the part most families never hear until it is too late. If this is the kind of trap nobody warned you about, subscribe. This channel is built for exactly these decisions. The ones that look harmless until the paperwork is already signed. Adding a child to a deed does not automatically mean every family owes a massive tax bill right away. The result depends on the deed, ownership share, state law, timing, value, basis, who lived in the home, and what happens later. But that is exactly why you should not treat this as a casual favor. This is where families get fooled, because they use normal family language for a decision the tax system sees differently. Robert does not think he gave Lisa a taxable asset. He thinks he just added her name. Lisa does not think she received a financial transfer. She thinks Dad is trying to make things easier. The family does not treat it like a sale, because Lisa did not hand Robert a check, but the IRS does not need cash to change hands before something matters. If you add your child to the deed, and your child receives an ownership interest without paying fair value, that can be treated as a gift. A gift does not always mean someone owes gift tax immediately, but it can create tax paperwork, basis consequences, and future capital gains exposure. The mistake is thinking no money changed hands, so nothing happened. Something did happen. Ownership moved. Robert's mistake was not that he loved his daughter. His mistake was assuming love changed the tax rules. The tax system looks at the property interest, the value, the basis, whether the transfer was a gift, and later, when the house is sold, who owned what share. If the home is worth $650,000 and Lisa is added as a half owner, that ownership interest is not symbolic. It is real property value. Does that mean Robert automatically writes a gift tax check the next day? Usually no. In 2026, the annual gift tax exclusion is $19,000 per person. Gifts above that amount may need to be reported, but most people do not pay gift tax right away because of the lifetime exemption. Still, the basis problem remains. Regardless of whether tax is paid immediately, that is the trap. Families relax because there is no immediate bill, but the real cost is often delayed. Lisa does not feel any problem when her name is added. Robert does not feel poor because he is still living in the home. The house looks the same from the street. But legally, something changed. And when legal ownership changes, the future tax result can change with it. A lot of seniors do this because someone says, it is easier than a trust, or it avoids probate, or your child will already own it. But that advice usually stops too early. It talks about what happens when the parent dies, but it does not talk about what happens if the house is sold. It does not talk about whether the child lives there. It does not talk about carryover basis. It does not talk about whether the transfer should have been reported. Seniors are tired of paperwork and legal bills. They want someone to say, do this and your child will be fine. But the cleanest sounding answer can be the most dangerous one. So if your child is already on the deed, do not panic, but do not ignore it either. Start with the basics. Find out how the deed is written. Find out when the child was added. Then go deeper. Did they pay anything? What was the value at that time? Was a gift tax return filed? Does your child live in the home, or do they only appear on title? That is how you move from fear to control. The tax problem is serious enough. But once your child owns part of the house is no longer connected only to your life. It can become connected to your child's life too. When Lisa's name was added to the deed, Robert still thought of the house as his home. He still paid the insurance, he still paid the property taxes, he still paid for repairs. In his mind, nothing changed, except that Lisa would have an easier time later. But the deed showed another owner. What if Lisa gets divorced? What if Lisa has unpaid debts? What if Lisa is sued? What if Lisa goes through bankruptcy? What if Lisa passes away before Robert? These are not pleasant questions. But real planning is not about pretending bad things cannot happen. It is about asking what happens to the house if they do. The exact result depends on state law, deed language, and type of ownership. A joint tenancy is not always the same as tenants in common. A life estate is not the same as a transfer on death deed. Creditor protection rules can vary. That is why nobody should take a one-size-fits-all answer from a neighbor. A few years after Lisa was added, she went through a difficult divorce, and there were some unpaid debts from that period. Robert did not think any of that had anything to do with his house. In his mind, Lisa was only on the deed for convenience. But if Lisa owns part of the home, her ownership interest can become part of the conversation, especially when creditors, lawyers, or courts start looking at her assets. Even if no creditor ever touches the home, control can still become a problem. Suppose Robert wants to sell because the stairs are getting harder, and he wants to move closer to medical care. He thinks, this is my house. But Lisa is on the deed now. Depending on how the deed is written, Lisa may need to sign. If she delays, disagrees, or has tax concerns, Robert's simple decision can become a family negotiation. Then there is the sibling problem. Robert has another child, Mark. Mark lives 2 states away. Robert did not add Mark to the deed because Lisa was the one helping every week. Later, Mark finds out Lisa's name is on the deed. He wonders whether Robert meant to give Lisa the house. He wonders whether Lisa pushed for it. Lisa feels attacked because she really was helping. Robert feels guilty because he never meant to start a fight. This is how a deed shortcut turns into a family wound. If this one warning made you think of your own deed or your parents' deed, hit like. Not for me. Do it because another senior needs to see this before they sign a document that sounds harmless but changes everything. This does not mean every child is irresponsible. It means even a good child has a real life. The risk is not always character. Sometimes the risk is life. Now the next part is where families make their biggest tax assumption. They think the home sale exclusion will save them because the house was Robert's main home. But once Lisa is on the deed, the IRS does not only ask whether Robert lived there. It can ask whether Lisa did. Many families think the home sale exclusion will save everything because the house was the parent's main home. And for Robert, that may be partly true if he meets the rules. But once Lisa is on the deed, the IRS does not only look at Robert's life, it can also look at Lisa's life. Most homeowners have heard this rule. If you sell your main home, you may be able to exclude up to $250,000 of gain if you are single, or up to $500,000 if you are married filing jointly. That rule is real, but it is not a blanket shield for every person whose name appears on the deed. The exclusion is not attached to the house like a sticker. It is attached to the taxpayer who qualifies. Robert lived there for decades. Lisa never moved in. She had her own house, her own address, and her own tax return. She was on Robert's deed because the family wanted to avoid probate, not because Robert's home became Lisa's main home. Let's make it simple. Robert's home sells for $650,000. His adjusted basis is around $140,000. That means there is roughly $510,000 of gain before selling costs and before applying any exclusion. Robert says, "But I lived here. I thought the home sale exclusion protects me." He may be right for his share if he qualifies, but Lisa's share is a different question. If Lisa owns half the house and her half is treated as a lifetime gift, then her half of the gain does not automatically disappear just because Robert lived there. Lisa has to look at her own ownership, her own use, and her own basis. If she did not live in that home as her main home for the required time, she may not qualify for the same exclusion Robert expected. That is the trap. The family thinks the house has one tax story, but the IRS can see two taxpayers. This is why "my child is on the deed" is not the same as "my child gets my tax protection." Lisa may be the loving daughter who helped Robert, but if Lisa did not live in the home, the rules do not give her the home sale exclusion just because she was helpful. The rules look at ownership and use. Now details matter. Ownership percentage matters, deed language matters, state law matters, whether Lisa paid anything matters, selling costs can matter, whether Robert is widowed and when his spouse died can matter. Every family does not get the same answer, but the warning is simple. Do not assume the home sale exclusion will clean up a deed mistake. Same house, different people, different questions. If Robert had talked to an estate attorney first, he might have learned about other options. Depending on the state and the family, a transfer on death deed may be available. A revocable living trust may be appropriate for some families. A will may still be part of the plan. A life estate may come up in some cases, though it has its own risks. The point is not that one tool is perfect for everyone. The point is that Robert needed a plan, not a shortcut. If you want to see exactly what safer options exist, comment the word deed below. I'll put together a full breakdown on the alternatives. Now let me bring all of this together into a before you sign checklist. If your child is already on the deed, do not panic. Panic makes people sign more papers without understanding the first paper. And if your child is not on the deed yet, do not rush to add them. Not just because somebody told you it avoids probate. Avoiding probate is not a victory if the route creates a capital gains problem, or a control problem, or a family fight. Before you change the deed, pull the current deed. Look at exactly how the home is titled. Is the child already listed? Is the ownership joint tenancy, tenants in common, a life estate, or something else? Is there a transfer on death clause allowed under your state's law? These words matter. Then ask when the child was added, or when you are planning to add them. A child added during your lifetime can be treated very differently from a child who receives property after death. Robert thought the only question was, will Lisa avoid probate? The better question was, what changes if Lisa becomes an owner now instead of receiving the house later? Next, find the basis records. Look for the original purchase price, closing documents, and major improvement records. A roof can matter. An addition can matter. New windows can matter. A major kitchen renovation can matter. A new HVAC system can matter. Repairs are not always treated the same as improvements, so do not guess. After basis, get a reasonable idea of the current value. A house bought for $90,000 and now worth $650,000 is a property with a large appreciation gap. The bigger the gap between basis and value, the more dangerous a casual deed change becomes. Then ask directly whether adding your child creates a gift. If your child receives an ownership interest and does not pay fair value, the transfer can be a gift. Gifts above the annual exclusion may need reporting, even if no tax is paid immediately. Because no cash changing hands does not mean nothing happened to the tax record. And that tax record includes the basis your child carries with the gift. So ask the question most families skip. What basis will my child have? If the child is added during life, they may receive carryover basis for their gifted share. If the child receives the property after death, the basis result may be different. Then look at the home sale exclusion. Do not assume it covers everyone on the deed. Ask whether you qualify. Ask whether your child qualifies. Ask whether your child actually lived in the home as their main home. Ask what happens if you sell during your lifetime. Ask what happens if your child sells after your death. Look beyond taxes too. Ask what happens if your child gets divorced, has debts, gets sued, refuses to sign a sale document, or dies before you. Then ask about control. If you add your child, can you still sell? Can you refinance? Can you use home equity? Can you change your mind? Can you treat all children fairly later? If the answer is unclear, you are not ready to change the deed. Do not let anyone tell you the only choice is probate or adding your child to the deed. Compare the alternatives with a qualified estate attorney and tax professional. Your state matters. Your house matters. Your children matter. Your tax basis matters. And your care concerns matter. Copying a neighbor's plan is dangerous because you're not planning with their facts. You are planning with yours. Before you sign anything, take the deed to the right professional. Take the purchase records. Take the improvement records. Take the estimated value. And take the family details. Then ask one direct question. If I add my child to this deed now, what tax, legal, control, and family problems am I creating later? That question is mature. That question protects your child. The IRS does not tax intentions. It follows documents, dates, ownership, basis, and sale numbers. So here's the final warning. If your child's name is already on the house deed, get the deed reviewed before the house is sold. If your child's name is not on the deed yet, get advice before you add it. And if your real goal is to protect the home, avoid probate, reduce taxes, and keep peace in the family, then do not start with a signature. Start with a plan. Because the most expensive family mistakes usually begin with the words, "It's just paperwork." It is not just paperwork. It is your house. It is your child's future tax problem. It is your control while you're alive. It is the inheritance your family may fight over later. And if the deed is handled wrong, it can become the capital gains disaster nobody saw coming until the home was already sold. If your next worry is protecting the house from nursing home costs or Medicaid recovery, watch the next video on the screen. Because deed mistakes are only one way families accidentally put the home at risk, and the next mistake can be even harder to undo.